The United States is about to decide whether it wants to be the home of the next financial system or a spectator while other countries build it. That is not an exaggeration. That is the actual stakes of the legislative conversation happening in Washington right now around the Clarity Act. Because what is being debated in congressional committee rooms and at blockchain summits is not just a set of rules for cryptocurrency. It is the legal architecture that will determine whether the most sophisticated financial institutions in the world can build blockchain-based products and services on American soil with the regulatory certainty they require, or whether they continue doing what many of them have quietly been doing for the past several years, building in Singapore, in Dubai, in the UK, in Switzerland, in any jurisdiction where the legal ground is stable enough to support a long-term infrastructure investment. That choice has consequences that extend far beyond the crypto industry. It has consequences for American financial competitiveness, for American capital markets, and for the question of which countries' legal and technical standards become the defaults for the next generation of global financial infrastructure. To understand what the Clarity Act actually does and why its passage would represent a genuine structural shift rather than just another regulatory announcement, you have to start with the problem it is designed to solve. The fundamental challenge that has made the United States uniquely hostile to crypto institutional development over the past several years is not that regulators dislike cryptocurrency. It is that the existing legal framework for financial regulation was built in an era when the assets being regulated fit clearly into established categories. A stock is a security. A barrel of oil is a commodity. A dollar is a currency. The rules governing each of those asset types were written for a world where the distinction between them was clear and where assets stayed in their categories over time. Digital assets broke that framework almost immediately. A token can function as a payment medium, as a store of value, as a governance right, as a unit of access to a software network, and as a speculative investment, sometimes simultaneously, sometimes shifting between these functions over its life cycle. The existing legal framework had no coherent way to handle that complexity, and the regulatory agencies that were supposed to provide clarity spent years arguing with each other about jurisdiction rather than producing workable rules. The result was an environment where any company building on digital assets in the United States was operating under permanent legal uncertainty about whether its activities were compliant, which regulators would claim jurisdiction, and what disclosure or registration requirements might apply. That is not an environment in which serious institutional capital makes long-term infrastructure investments. What the Clarity Act attempts to do is replace that uncertainty with a statutory framework that is durable, comprehensive, and clear enough to support institutional decision-making. Senator Tim Scott, who has been one of the bill's primary architects, has stated explicitly that the goal is to codify the legal status of digital assets into U.S. law in a way that prevents future administrations from easily reversing the framework through regulatory guidance alone. That distinction between legislative law and regulatory guidance is not a procedural technicality. It is the difference between a foundation that institutions can build on for a decade and a policy position that can be reversed by a new SEC chair in the first 6 months of the next administration. The instability of guidance-based regulatory frameworks is something that every compliance officer and general counsel at every major financial institution understands viscerally. They have watched crypto regulatory positions flip between administrations. They have seen guidance issued by one SEC leadership team challenged or withdrawn by the next. Durable institutional investment requires durable legal ground, and durable legal ground requires statute, not interpretation. The Clarity Act's fundamental promise is a framework embedded in law rather than administrative discretion. The specific structure that the SEC has been developing alongside the legislative push involves a token taxonomy that creates 4 categories of non-security digital assets. Digital commodities, which are assets whose value derives from network function and market dynamics. Collectibles, which encompass non-fungible assets with unique provenance characteristics. Tools, which cover assets that function primarily as software access mechanisms. and payment stablecoins regulated under the Genius Act framework, which addresses dollar-denominated digital currencies used primarily for payment rather than investment. Only the fifth category, digital securities, which are tokenized versions of traditional securities like stocks and bonds, would remain subject to the full weight of securities law. The implications of this taxonomy are significant for the institutional landscape because it returns the SEC to what Senator Scott describes as its core mission, overseeing investment securities, while handing primary regulatory authority for most digital assets to the CFTC under a commodity framework that has historically been more compatible with the kind of trading and settlement activity that characterizes crypto markets. The Commodity Futures Trading Commission has a regulatory culture that focuses on preventing fraud and manipulation, rather than imposing the registration and disclosure requirements that define securities regulation. For institutional participants, moving from an ambiguous securities framework to a clear commodity framework means moving from a space where any activity could potentially trigger an enforcement action to a space where the rules are defined and the compliance requirements are knowable in advance. The bipartisan dimension of the current legislative push is worth understanding because it is what makes this moment different from previous attempts to pass crypto market structure legislation. Senator Lummis, who has been one of the most consistent advocates for clear crypto legislation in the Senate, confirmed that the Clarity Act is scheduled for committee markup in April, with efforts underway to combine the digital asset provisions with the commodities portion being worked through the Agricultural Committee. The involvement of Senator Tim Scott, who chairs the Senate Banking Committee, gives the legislation an institutional weight that previous crypto bills lacked. The acknowledgement by multiple lawmakers that addressing the ethics issue of elected officials' own digital asset holdings is necessary to secure bipartisan support shows a degree of political self-awareness about the optics of the legislation that earlier efforts failed to demonstrate. Congressman Miller and other members have been explicit about the need for stable crypto tax policies that will endure across administrations, which reflects an understanding that the credibility of any regulatory framework depends on its perceived durability rather than just its current provisions. The question of whether this legislative momentum will produce a final bill that reaches the president's desk on the timeline being discussed is genuinely uncertain. Congressional timelines are unreliable. Political dynamics can shift. The complexity of the market structure issues being addressed means that drafting compromises can consume enormous amounts of time, but the direction and the political alignment are more favorable than they have been at any previous point in the history of U.S. crypto legislation, and that matters even if the exact timeline remains unclear. For assets like XRP that spent years in regulatory limbo, the Clarity Act's potential passage represents a different kind of significance than it does for assets that were never directly challenged by regulators. XRP's situation under the previous regulatory environment was a specific and costly form of the general uncertainty problem that affected the entire industry. The SEC's lawsuit against Ripple classified XRP as a security, which created a legal cloud that prevented U.S. institutional participants from integrating it into custody platforms, payment products, and investment vehicles, regardless of their view of the underlying technology. The SEC's recent interpretive guidance, which classified XRP as a digital commodity alongside Bitcoin, Ether, and Solana, provided meaningful near-term relief from that specific legal exposure. But interpretive guidance is precisely the kind of regulatory position that the Clarity Act is designed to replace with something more permanent. If the Clarity Act passes and establishes a statutory definition of digital commodities that includes assets like XRP by their characteristics rather than by regulatory interpretation, it creates a legal basis for institutional integration that does not depend on the current administration's continued support of that interpretation. The same dynamic applies to every digital asset operating under guidance that could be reversed. The Clarity Act's significance for XRP specifically is the same as its significance for the entire asset class generally, a framework embedded in law rather than subject to administrative discretion. The institutional capital question is where the Clarity Act's real economic significance lies, and it is a question that deserves serious analytical attention rather than speculative optimism. The financial institutions that have the capital and the operational capacity to transform crypto markets from a relatively niche asset class into a component of mainstream institutional portfolios are not absent from the crypto space because they lack interest. They are absent because their compliance departments, their legal teams, and their boards of directors have consistently concluded that the regulatory uncertainty creates liability exposure that is not worth accepting. A clear statutory framework changes that calculation in a specific and mechanical way. When the legal status of an asset class is defined by statute, the compliance analysis that precedes institutional investment becomes feasible to complete in a reasonable time frame with a reasonable degree of confidence in its conclusions. When the legal status depends on regulatory interpretation that can change, the compliance analysis is open-ended and the conclusions are always provisional. Provisional compliance analysis does not support the kind of multi-year infrastructure investment decisions that institutional adoption requires. The Clarity Act, if it passes in a form that provides the statutory clarity its proponents are describing, removes the specific barrier that has kept the largest pools of institutional capital on the sidelines of this market. Whether those institutions actually deploy capital into the space and at what scale is a separate question that depends on investment thesis, risk appetite, return expectations, and competitive dynamics that the legislation does not determine. The Clarity Act opens a door. Whether institutions walk through it is their decision, and the historical precedent for how quickly institutional adoption accelerates after regulatory barriers are removed varies considerably across different markets and different time periods. The U.S. competitive position in global crypto infrastructure development is an angle that legislators have been increasingly explicit about, and it reflects a genuine economic concern that goes beyond any particular asset's prospects. The United States has the deepest capital markets in the world, the largest concentration of venture capital, the most sophisticated financial talent pools, and the strongest track record of financial innovation over the past century. These advantages are not transferable to other jurisdictions automatically, but they can be forfeited if the regulatory environment makes it structurally impossible to deploy them in the crypto infrastructure space. The talent migration that has already occurred with developers, entrepreneurs, and institutional professionals building in other jurisdictions because the U.S. regulatory environment made domestic operations unworkable represents a real competitive loss that compounds over time as the institutions and networks built elsewhere develop deeper roots and stronger network effects. Senator Lummis has stated explicitly that the Clarity Act is intended to establish the United States as the crypto capital of the world by providing clear rules, strong consumer protections, and an environment that fosters American innovation rather than suppresses it. The current trading fee structure in U.S. crypto markets, which is higher than in most international markets and drives the primary liquidity pools offshore, is a direct consequence of the regulatory fragmentation that makes U.S. market operations more expensive to run. Lawmakers have acknowledged this as a structural problem that clear federal regulation could address by creating a unified framework that reduces compliance costs and enables U.S. exchanges to compete effectively with their international counterparts. The open question that the Clarity Act's potential passage leaves unanswered is the most important one for anyone trying to evaluate what this legislative development actually means for the future of digital assets in America. Regulatory clarity is a necessary condition for institutional adoption. It is not a sufficient one. The history of markets that received regulatory clarity after periods of uncertainty is a mixed record of cases where adoption accelerated dramatically and cases where the expected capital flows failed to materialize because the underlying economics of the market were less compelling than the regulatory barrier had made them appear. Regulatory barriers can mask both genuine opportunity and genuine weakness. Removing the barrier reveals which was which. The digital asset infrastructure being built by Ripple, by blockchain developers, by tokenization platforms, and by DeFi protocol teams will be evaluated on its merits by institutions once the regulatory question is settled. Those merits include technical reliability, transaction cost efficiency, settlement speed, custody security, and compliance tooling. They include the depth of liquidity available for institutional transaction sizes. They include the quality of the counterparty relationships and the legal documentation frameworks that govern institutional transactions. All of these factors are developing in parallel with the regulatory conversation and will determine the actual pace and scale of adoption, regardless of what the Clarity Act says. The legislation can create the conditions for the market to develop. It cannot guarantee that the market will develop at any particular speed or to any particular scale. Whether the next financial system is built primarily on blockchain infrastructure, whether American networks and companies lead that build-out, and whether the digital assets that currently exist capture the value created by that transition are questions whose answers will only become clear over a time frame much longer than any legislative timeline. What the Clarity Act can do is ensure that the United States at least has the option to compete for those answers rather than having already forfeited that option through regulatory paralysis.